in terms of the recession, I think it starts with the equity market. We believe in this concept called hyperfinancialisation, whereby in the US, it's the financial markets which lead the economy in a kind of screwy kind of way. But essentially, I think if we are in the process of seeing a top in equities, which could see the final gasp of inflation as one of the triggers for that bigger top, which may kill, expectations of rate cuts in September and November, then I think the resulting correction in equities will ultimately drive us into a recession. So it's all kind of connected, Anthony, right? There's very, there's lots of moving parts here. It's actually a very complicated macro period. I think, as I said, if I just had to put my money on something, it would not be that the equity market goes high. The average drop of the equity market in a recession going right back to 1929 is pretty much 30%.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back Julian Brigden. So Julian is the head of research at Macro Intelligence 2 Partners. So Julian, thanks so much for coming on the podcast today.
My pleasure.
I look forward to the conversation. You are a frequently requested guest, so it's great to have you back on. It's been a while since we've spoken, and everyone's really interested in hearing, what are your thoughts on what's happening in the markets and the economy at the moment?
Yeah. So, we were just chatting a little briefly offline, and I think the biggest squabble, let's say disagreement that I have with the market is this sort of assumed euphoric Goldilocks kind of outcome. And I was looking at the B of A do a fantastic survey, and I'm just going to pull it up to give you some sort of indication. But it's a survey of professional fund managers, so it's kind of the cutting edge. So if you look at their latest survey, Global Fund Manager Survey, it says that higher inflation is no longer seen as the biggest risk. Geopolitics is seen as the biggest risk. Okay, it doesn't sound too bad. 87% now expect lower rates. 72 predicting a minimum of 3 cuts starting in September over the next 12 months. Interestingly, though, despite the fact that we're going to get lots of rate cuts, you have 68% who expect a soft landing, and an additional 18% who expect no landing at all. So in other words, we're not even going to slow down. We're just going to get 3 rate cuts. There's going to be no slowdown. Everything's going to be great. And I look at this and just think this is just extreme Goldilocks, right? Absolutely extreme Goldilocks, Anthony. And I think clearly this is what everyone would want. Clearly this is what the Fed would want, right? They would like to defeat inflation without inflicting any significant pain on the economy. But statistically, that's actually not what happens. I mean, I've gone back and I've looked at all the various tightening cycles since the 1960s, and there have been 12. And pretty much, probably, maybe with the exception of Paul Volcker, who really did want to inflict pain to defeat inflation, I'm pretty certain that most tightening cycles, the Fed was trying to land a soft landing, right? That's what they were trying to do. It's just bloody hard, right? It's bloody hard to defeat inflation thoroughly without inflicting pain on the labor market to the point that you trigger a recession. So if you look at those 12 tightening cycles, you had 7, let me get this right. No, you had 8 recessions. Okay. You had 1 reacceleration where they started to cut. They thought they defeated inflation. Inflation came back. And you had, are we up to the right number? No, I'm off 1. So 7 recessions, 8 recessions, 8 recessions, 1 reaccelerations, 3 quote unquote soft landings. But in every case, those soft landings occurred with significantly higher levels of unemployment, which means, Anthony, as you go through the soft landing and then you reaccelerate, or in the case of those 18% of people who don't think we're even going to get a slowdown, as the economy keeps growing, we have got plenty of people to employ without creating wage inflation. And this is very, very hard, this balancing act. This is why soft landings are so hard. Like, you don't tighten enough, inflation comes back as growth reaccelerates, or you tighten too much, you lose control of the labor market. And labor unemployment never just rises a bit, right? It doesn't just go from 3.4 to 4.1 where we are now, and then go sideways at 4.1 for the next 5 years, right? It either goes down or it goes up. If it goes down, the risk is your inflation's coming back, which happened in the late 60s. If it goes up, then you've got a recession. So I look at this setup in the markets, and I just think, this is partly the fault of the Fed, right? Who really keep telling us, it's okay, we're coming to your aid, we're coming to your aid, we're coming to your aid, we're going to cut rates, we're going to achieve, the soft landing, we're going to do it. And I don't know whether they're smoking something. I think there's an element where they're trying to prevent a recession in front of the election. But bloody hell, I mean, I think the odds of them pulling it off are, 1 in 4, maybe. And I would personally, I think it's even lower, 1 in 2. I think we're either going to get, and I think we could get a combination of a re-acceleration in inflation and then a recession. So we'll see. But I just don't buy this euphoria.
Okay, yeah, a lot to unpack there. So, you're thinking that we could get a recession, and before the election. That's
no, I don't. I think that would be pretty quick. I mean, what I think we could get was we can get the conditions that ultimately trigger the recession. You could get, I think we're in the process of seeing, I think, a pretty significant top on stocks right here, right now. We've been warning our clients about the excesses in the system across all sorts of metrics, particularly here in the US, be it tech stocks, whatever. I know that the market, the bulls want you to believe that finally we've got the rotation going on. We're going to rotate out of, all these tech stocks, and we're going to go into value, and then the economy is going to expand. I just think that's bullshit. I just don't think those metrics hold at all, for all the reasons that I've outlined. Because I think if you tried that and you tried to accelerate broad growth again, economic growth again, you would run straight into the inflation problem like we did in the late 60s. I think, in terms of the recession, I think it starts with the equity market. We believe in this concept called hyperfinancialisation, whereby in the US, it's the financial markets which lead the economy in a kind of screwy kind of way. But essentially, I think if we are in the process of seeing a top in equities, which could see the final gasp of inflation as one of the triggers for that bigger top, which may kill, expectations of rate cuts in September and November, then I think the resulting correction in equities will ultimately drive us into a recession. So it's all kind of connected, right? There's very, there's lots of moving parts here. It's actually a very complicated macro period. I think, as I said, if I just had to put my money on something, it would not be that the equity market goes high. The average drop of the equity market in a recession going right back to 1929 is pretty much 30%.
Yeah, and do you link it sort of to something similar to the 60s? You mentioned that a few times. Is that what you see the economy, or is that just the inflation picture?
Well, I think it depends. I think the 60s was kind of an interesting period. We'd had a very, in the early 60s, we had this sort of halcyon period where inflation was incredibly low. We didn't have the level of debt, so we weren't so worried about deflation. So the central bank, who kind of in the mid 60s thought they could kind of run the economy a little hot, unemployment started to fall a little bit lower than their model suggests was feasible. They thought they could kind of risk it. And what they didn't take into account was this big pro-cyclical fiscal boost that we had from Johnson's Great Society, the so-called guns and butter kind of, or the butter bit of the guns and butter expression. And then the guns bit started to come through with Vietnam. And so you had a central bank that kind of thought they could run it hot, not dissimilar to these guys. They could take the chance, they could run the risk, right? Pre the breakout of inflation from COVID. They were wrong. They raise rates. They get a wobble in the equity market, a bit of a credit crunch. They back off, and they back off into ongoing fiscal spending, Anthony. So we never lose that momentum in employment. Very unusual, right? Typically, as the economy would, as the stock market would go down, you'd lose that momentum in employment, and you end up with a recession. But this time it didn't happen because you had ongoing fiscal spending. So if you look into 2025, and I have to say that I look at 2025 and I think the level of macro uncertainty, I don't think I've ever seen a more extreme potential outcome. And I'm not claiming to have any clarity at this point. I think we need to know a lot more about what policies Trump potentially will enact, assuming, which I think is the odds-on bet, that he will win. But there's a lot of uncertainty in that. But the point is let's say we have a relatively robust fiscal spending environment. We continue to see onshoring, but it's supported by this sort of government spending. Then I think this period of the lull that we have currently in inflation may prove to be the transitory bit, and it comes back and actually ends up being far stickier than we had actually envisaged. And then you're going to get into a really ugly period between markets that have expected the rate cut, a president that demands the rate cut, and a Fed which I think will be trying to state its independence. And I think that vol could be pretty bloody ugly.
Yeah, I imagine if sort of Trump sees inflation, or that there's issues in the markets or anything like that, he's going to be knocking on Powell's door, going hard.
Yeah, I mean, but he can do what he likes. It's bugger all he can do, right? I mean, this is depends on Powell. Powell is a Republican, right? But it really depends on Powell's demeanor, and I think so far, I don't think he's been inclined to bend, right? I think all of these central banks, and I think it's interesting if you look around the rest of the world, that essentially in most developed economies, they're facing, with the exception of Japan, they're facing kind of a similar problem. The ECB, particularly the RBNZ, the Reserve Bank of New Zealand, the RBA, the Reserve Bank of Australia, and even the Bank of England are facing kind of the same problem. That the labour market remains very strong. And in an environment where the labour market remains very strong, your core service inflation, which makes up the bulk of core CPI, core PCE, tends to be very strong. Now, goods prices, which is what we've seen here over the last 20 years outside COVID, where you finally gave goods producers some pricing power, are pretty much flat. At the moment, they're running very negative. That's one of the factors which is weighing on headline inflation, getting everyone excited. But those core services linked to a labour market are very, very strong. And Madame Lagarde made exactly that observation again today. And the RBNZ has made that exact observation. And they've actually been more explicit. And I think they've been honest in a way that some of the other central banks have not been. They've explicitly said to New Zealanders, and they call them, particularly they're focused on what they call price setters, so companies and workers demanding wage increases. They've said, look, you need to moderate your price increases, and you need to moderate your wage claims, or we are going to have no choice but to essentially drive unemployment to the point that we destroy the demand and put the economy into recession to defeat inflation. I think that's realistically exactly the same problem facing the Bank of England, facing the ECB, facing the Fed. It's just that the Fed is not honest enough for whatever reason, maybe the dual mandate, maybe politics, to actually fess up to that and come clean. And I think they should have told that to the market. I think they would have had a much easier job at actually defeating the animal instincts, which are now threatening to, either we're, have caused this, have created this reacceleration that we're seeing, and now I think have potentially reached a level where we're facing bubble-like territories in the US equity market.
Okay. But then I guess if you look at like the past 14 years, or 16 years even, service inflation has always been quite high. And as you said there, the sort of products or the inflation has been lower.
I
So
mean,
do you think we're just going back to that trend? Because I guess during
no,
COVID,
I think,
there,
look, I mean, you have to qualify when you say, quite high. Yes, it's been the main driver of the inflationary picture. Like I said, it's basically 2/3, 3/4 of sort of CPI is sort of goods inflation. But if you look at it at the moment, I mean, service is really, really high. I mean, core service inflation, so stripping out energy, is running at over 5%. It's been stuck at over 5% now since, I mean, really, okay, since the highs, but I mean, and we're coming down gradually. But to put it into perspective, the last time we saw service inflation at this level was in 1991, right? Core service inflation has generally been somewhere between, and these are even in periods where the Fed was hiking, right? Stable core service inflation is sort of 2.5, 2.75%. We're double that. So the answer is no, service inflation is not low enough, right? That's why this concept that ding dong, the witch is dead, we have defeated the inflationary witch is ridiculous. It's a crock. The only way that you will realistically defeat this is there's two options. One, we get the AI productivity nirvana, which the bulls want to believe in. I mean, we can debate that, but I'm questionable whether it's going to happen this year. Or we drive unemployment sufficiently high, like the RBNZ said, that it breaks the back of the consumer and destroys pricing power for the corporate sector. But that's a big recession. Those are your choices. That's what history tells you.
Yeah, and it does seem like we're getting more sort of unemployment data coming through, where it's today we had, I think it was sort of
claims were a little higher.
Claims.
Yeah, I mean, I think, look, here's the thing that we have to remember. I mean, there is no question, and if it didn't work like this, God help us, right? If you raise rates to this high, nothing happened. But the objective of raising rates is to squeeze the economy, right? And there is no question that we are seeing a softening of the labor market, right? But it's coming off ridiculously extreme tight levels, right? So one metric I use is a metric of sort of labor demand, and at its high, it was commensurate with 1% unemployment in the US. So in other words, if we could have found the workers, right, if they turned up and taken the job, unemployment would have been 1%. Now it's softened since then, Anthony, but it's still commensurate with 3.5% unemployment, not 4.5, not 5.5, 3.5. So yeah, it's gone from 1 to 3.5, but that ain't a weak labor market. That's a softer labor market than an absolute extreme. There's no real signs of layoffs that you can see in the data. I'm not saying that's not coming. It could come. It will come if the equity market continues this way on this downward decline, because CEOs will just start firing people at some point when their stock price is too low, because they'll go to cost cutting to try and raise those stocks. But that's kind of the point, right? This is we're not there yet, right? And this is why this is so hard, right? It's very, very difficult just to have a little slowdown in unemployment or a little rise in unemployment. That's not how the metric works, right? History tells you that's just not how it happens, and anyone who tells you otherwise is wrong. So I think the unemployment rate is up. I think it's distorted somewhat by the immigration issue. I think that's making it quite hard to read. As I said, macro is quite a difficult thing at the moment. And I think the labour market is softening. It isn't softer yet.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in, and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views. We've hundreds of thousands of different people listening in. So I just wanted to thank you. You know, I started this as a student, and now currently working, and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So if you can, great. If not, no problem at all. Thanks for listening, and let's get back to the show. Okay. Makes sense. So you're saying that you think we could be at a sort of a peak in the markets, and that would then lead for economic rollover. Yep. Do you see this being something similar to Great Recession? Is it hard to predict? Is it just,
it feels to me like, when I look at the excesses in the labour market, if it looks like a combination of, it looks really more like the dot-com bubble than anything else. It looks like a combination, but kind of on speed and much greater, larger degree, because back in 2000, the sort of the stocks that were in excess, many of the stocks that we trade today, you had sort of, anomalies like this thing called pets.com, right? But the Microsofts, the Ciscos of the world, real companies have gone on to do great things. Those are relatively minnows, right, in terms of their market cap. Now they're behemoths. And I think the damage that can be wrought from a correction in these markets could be inordinate. And I think they are bubblicious. I've been saying for, since the beginning of January, when we first put the first piece out on this, that, NVIDIA, the market's darling, has all the attributes of a classic bubble. Right? We've gone back and looked at every single bubble in history where you can chart it, so back to sort of the early 20th century. And they follow a pretty scripted path, and NVIDIA ticks every single box. And it looks to me that right now we are in the what is referred to as the down leg of the bull trap. Now, the bull trap comes after the big kind of parabolic blow off. You think this thing is going to the moon, and it fails. It then drops hard, which is in the phase that we are in. I think this move could take us to 96, 97, 30 to 40% declines are in this sort of move are not unusual, right? 30 to 40% off the top, it would not be unusual. We then think it'll bounce, and that's if it fails to make a new high. If it fails, whatever number, we go from 97 to back to 130 or 125 or something like that, and it fails at that level, then that's when typically the bull trap closes, and that's when stocks decline. The stock declines, and that's it historically. Now, the fundamentalists will say, "Oh yeah, but earnings, blah blah blah." And my point is bubbles are not about fundamentals, particularly. What fundamentals drive the story. So the better the story, the better the fundamental story, potentially the bigger the bubble. The only bubble that I can't kind of get my head around is the tulip bubble. I can't quite see, why that became a bubble. It's hard to figure out the fundamentals of a bloody tulip. But most bubbles have some sort of fundamental thesis. Just like AI has a fundamental thesis. But what nails the top is not typically fundamentals. What nails the top is over ownership. Bubbles in the up move, in the particular that last bit of the sort of parabolic blow off top, are about greed. So it's psychology that drives people to, it's the whole, I get the shoe shine guy who says, well, haven't you got this, right? And I had a personal experience of that in, back in 2000. I had a physiotherapist that twisted my ankle, and in late 99, and the guy was like, oh, it's a good job you got me, and next year I'm retiring. And I was like, oh, really? And he goes, yeah. I've got all this Cisco stock, and at the current trend, it'll be worth like $3 million, and I'm going to retire. And I just that right, that's what people do. They straight line. And when you start working that on a societal basis and the assumed rate of sales that they have to do to achieve that, you just begin to realize the math doesn't make any sense. So this is really about greed. And now we're in a bit of we're beginning to enter the phase which is going to be driven by fear. I was up $50,000. Oh shit, now I'm only up 30, right? Better sell and lock it in. I bought Nvidia at 130. Oh shit, it's 90. I'm losing money. Better sell, right? There's a very different psychology.
Yeah, and we're seeing that when you have one down day, that people are already starting to get jitters. So you'd imagine if it goes down that 10, 20, 40%, then that's when the real fear comes along.
As I said, I mean, that's what bubbles do. They do, you'll get to a point where everyone will go, oh, now it's really cheap, right? And then they'll try and buy it. And if it is a bubble, then you would expect it to fail, because you're going to have a lot of volume where people have ended up buying, say, Nvidia, close to the highs. So you'll be that guy who, bought it at 120, watches it go down to, 90, or bought it at, say, 130 and watches it go down to 90. And when it goes back to 120 or 130, it's like, thank God, yours, right? And so you get this overhead supply hanging over the market. So look, I mean, I think there's lots of stuff like that. I mean, I tweeted this morning, for example, that, I look at Netflix, right? We know the consumer's having a hard time. You can see it in various stocks, right? Some of the restaurant stocks, beginning to see it at the low end in the airline space. Even some of the higher end airlines now are starting to report questions. But, we've rallied Netflix, which is basically a consumer facing stock, right? I mean, they sell a consumer product. It's not a business product. It's not an AI product, right? They sell entertainment to the masses. And, we've seen that stock go up from 2022. It was 170, and it's gone straight up to 700, right? Great trade. Trouble is, it's got a perfect double top, exactly the same high that it's failed at where it hit in 2021. The analysts have all their earnings are significantly lower in 2025 than the stock is trading at, which suggests that this is kind of overdone, even if you believe the analysts. I mean, they're not that bullish. And, it's not hard to imagine that people are very, very long. So it's going to be really interesting to see what one of the Mag 7, the undisputed leaders of the world, can deliver tonight, because they better bloody deliver. Right? Otherwise, tomorrow, this thing will be down 20%.
Yeah, the volatility in some of these stocks after a bad performance is mental. But then I guess, why don't you buy into the, rotation theory? Because I guess it does make sense that we've had this, these leaders pulling up the markets for so long. There's going to be some stocks that are going to benefit from decreasing interest rates.
Because, well, look, I mean, there's a couple of problems. Firstly, just the weighting of the indexes, right? I mean, it's very, very, very hard to take all this money out of, a Netflix or Nvidia or a Microsoft, and you're talking trillions here, right? And easily put it into one of these other indexes, one of these other stocks, these smaller stocks. It's just the frictional vol that you create actually is pretty extreme. The second problem is, as I've said to you before, I don't buy that this looks anything like prior times of major rotations. I don't see the productivity, so this is not 95 to me. I don't see there isn't the slack in the labour market. So this is, these are the last times we were kind of these extremes in terms of growth of value. This isn't 2000, post the global financial crisis. This isn't 2020. 2009, post the global financial crisis. This isn't 2020, post COVID, right? So if we try and reaccelerate, we try and broaden that expansion in the economy out of these very select names, and we go into broad names, that would have to be associated and to be sustainable with a resurgence of growth, right? From where? We're already growing at 5.5% nominal GDP, so growth plus inflation, right? Doesn't get much better than that. What are we going back to? 6, 7, right? Absent the productivity miracle, we don't have the workers, right? In 2009, we had 10% unemployment. 2020, we had 10% unemployment. What this feels, which is the last time the growth value extreme was that great, so it feels like the dot-com bubble. It doesn't feel like that broadening out scenario. Unless we get that productivity from AI, you can't do it. It can last for, 3 months, 6 months, but I already see signs of inflation picking up. So I'm not even that sanguine that it could go on for that long before people go, oh, shit, really? Inflation's come back. How are we going to get those rate cuts? How's this broadening out going to happen? Right? And we're all wedded and betting on the Goldilocks. I don't see it.
Okay. And what impact do you think will this have on fixed income and I guess the dollar as well? I think I've heard you talk about long-term fixed income bear market.
Yeah, look, I mean, clearly if we go into recession, you'll get a rally in fixed income. I mean, certainly in certain part of the curve, right? Because the Fed will start to cut. Longer dated fixed income, I think, is problematic. I mean, I'm not saying it won't rally. I sort of could see 10-year yields falling to about 3% in a recession, but I don't think it's 0. I don't think it's 2, or any of those extremes. And I think the reason for that is because in a recession, the deficit will blow out. And certainly if you've got a Trump administration, his inclination will be to spend even more money. And I think that we're already in a pretty precarious fiscal situation. And that's even on the supply side. I think the problem on the demand side is the pool of global savings that's available to buy fixed income is shrinking. And so we're structurally on bears. I mean, as I said, drop to 3% is a big move, right? But that's a recessionary move. So I can see rates falling in a recession, don't get me wrong, but it isn't back to kind of lows. The dollar gets kind of interesting, and I think the reason for that is that typically the dollar rallies in a kind of risk-off environment. That's the first stage of the move. I'm not totally convinced that against all currencies it's going to do that. I'm actually I think there's a good chance that actually we could find that certainly dollar yen will fall, yen will strengthen. It's been a funding currency. So as those positions get unwind, as risk assets come down, the yen will strengthen, the dollar will fall. I think it's possible that the euro even rallies, because I think the Europeans have been big funders of US excesses. And as those excesses get unwound, right, we've written about this to clients today, it's possible a lot of the money goes home. So the euro and the yen I'm actually reasonably bullish on in going into a recessionary environment, which would be kind of unusual. But I think all the world's money is here, Anthony, right? And I think that's one of the key things. So if we do get a recession, the money just goes home and the dollar actually ultimately goes down.
Okay. And then would you say there's lots of dollars going back to the US? So that could be quite problematic as well.
No, I don't think it's quite the opposite. No. They leave. And the problem is we've had this virtuous cycle for the last 15 years of counterintuitively, thinking from an economic perspective, we've had a rising dollar, but we've had outperforming US assets, and we've had an outperforming US economy. And I think that cycle could be coming to an end. And I think we could see, not immediately, right? It takes a transitionary period, but we could see a falling dollar, underperforming US equity prices. Doesn't mean they don't go up, but they just underperform other equity prices, and a weak dollar. So I think a radical change from the last 15 years.
So would you say the markets that currently have a surplus and are sort of exporting those dollars to the US are going to outperform when that money comes back and is reinvested in their economies?
Correct. Yeah, correct.
Okay, so Japan, Germany, those type of.
Yeah, I mean, I think it was quite interesting to listen to the vice president, the Republican potential vice president last night. He was talking about how, they supported their allies, but the Europeans have to realize that, there are other priorities in terms of defense spending, and it has to be directed against China. And so they really have got to start standing on their own 2 feet. And you're like, okay, well, I don't disagree with that, right? The problem is that, if you go back and look at history and you look at, say, Pax Britannia, so when the UK was the dominant military power, or Pax Americana, which we kind of got now, there's an implicit deal here, right? So the way that it works is the reserve currency provided back then, it was the UK, now it's the US, is able to run very large deficits. And what they typically do, and the symbiotic kind of relationship, is that they agree. The way this relationships work is they provide military cover. So back post the Second World War, it was the US provided cover to Korea, Japan, Germany, right? And then to fund that military cover, it had to issue a lot of debt. Militaries are very expensive, as we know. And those countries that were providing that military cover to would buy that debt. And that was the symbiotic relationship. Well, you just told the Europeans, we're not going to do it anymore, right? We're not going to do that anymore. We're going to leave you to fend for yourself. Fine. Okay, then why should the Europeans recycle their surpluses back into US assets? And there's a lot of money sitting in US assets from Europe, a lot of money.
Okay, that's really interesting. So you're bullish on those countries. Is there anything else that you're bullish on at the moment?
At this point, I would say I'm bullish on a relative basis, because if we are going to risk-off environment, everything's going to fall. They will fall less than the US markets will ultimately. And then you wait for the easing cycle to begin, and then you can get outright bullish on things, right? And that in that sort of environment, let's say in a weak dollar environment, other areas just generally outperform. It doesn't mean that the US equity market didn't go up. I mean, it went up from 2002 to 2008. Looks like on paper it did well, but you'd have been better off being in Europe. You'd have been better off being certainly in dollar terms. You'd have been better off being in precious metals. There are better off being in emerging markets, better off being in energy, right, than tech. Like tech was the worst performing sector in that period. So it doesn't mean that stuff doesn't go up. It's just there are better investment opportunities when that dollar strength cycle turns. The dollar is a very, very important component.
Yeah, makes sense. So, Julian, thanks again for your time today. Really appreciate it. Last question is, what is one message you'd like people to take away from our conversation?
So I think, look, we're at a very, very precarious point. I think you have to be extraordinarily careful about doing what you have been doing recently, which is buying the dip. I think markets are long. I think they're extended. I think volatility historically picks up as we move into mid-October. I think this is a very dangerous time. Big picture, I think you have to keep an open mind as to whether this 15-year cycle that we've been in the US, which has been truly virtuous when it comes to the US, is on the cusp of starting to unravel. And in that environment, I think you have to keep an open mind on what you own. And I think it may not be the same things that you've owned for the last 15 years that have done you very well, right? Congratulations if you've ridden those. So yeah, I think we're at a really important transitional point.
Perfect. Makes sense. So, yeah, thanks again for your time. If anyone wanted to find out more about your work and what you do, where would the best place
So
to go?
look, if you're interested in subscribing, then contact support@mi2partners.com. And if you just want to follow my muses on Twitter or X or whatever the bloody hell we call it now, which seems to be looking more and more like bloody Instagram every single minute, right? We just get ads rather than actually useful information. But if you're still on that platform, at Julian at MI2 Partners.
Perfect. I'll put it in the description below, but thanks again for your time.
Cheers. Thanks very much, Anthony.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that, but it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.